Good afternoon. My name is Ainde Sunday. I'm presenting our Capstone project on behalf of Group H. Our project topic is evaluation of value at risk, methodologies on stocks, bonds, forex, and commodities. Risk management and measurement is a major task for financial institutions, industry practitioners, and regulators. Basel II Accord makes it compulsory for financial institutions to use the standardized measurement for credit risk, market risk, and operational risk. Specifically for market risk, Basel II Accord preferred approach is value at risk. The value at risk is defined as an estimate of how much an investment is likely to lose in a normal market within a certain holding period. Our research problems, aims, and objectives that we hope to tackle with this project is conducting an investigation of VR models using the 4 asset classes of bonds, stocks, forex, commodity as a suitable measure of risk. We are also interested in performing comparative analysis of each techniques through optimization of asset weights. We will also be looking at measuring financial risk using both parametric and non-parametric techniques, calculating expected shortfall in different time series within the last 10 years. We will also assess the primary drivers of differences in methodologies and conclude with discussion of limitation of VR. Our methodology will include data collection, time series data visualization, plotting of returns, estimation and graphing of cumulative returns, variance and covariance VR, historical simulation VR, Monte Carlo simulation VR, portfolio construction, expected shortfall, and stress VR. In terms of data collections, we collected 10-year data between 2009 and 2019 for stocks, bonds, commodity, and forex from Bloomberg. We're able to visualize our data, and it will be observed that the Nigerian Naira was flat from 2009 till around 2015 when it begins to rise. Also for the British pounds, it is observed that it starts to fall in 2006, while the Japanese yen was on a downward trend up to 2012, and it has been on the rise since then. This visualization helps us to gain an idea of the type of data sample that we'll be working with, especially as relates to the distributions of the time series. We then plotted returns. This helps us to gain an understanding of correlations as well as market volatility. As we can see here, we've seen a lot of volatility, mostly in Nigerian markets in 2010, 2015, and 2009. The same also goes for Eurostats, especially in 2010. For investors, their major interest is in cumulative returns, hence the reason why we plotted the cumulative returns of our assets. In this instance, we have actually visualized that of stock cumulative returns. The variance and covariance analysis is a parametric model that is based on normality assumptions of data distribution. The various steps involved include data collection, calculation of asset returns, data testing and graphing of returns, calculation of asset returns, mean of returns, calculation of standard deviation of asset returns, and we estimate VR for each asset class at different confidence level, 90, 95, and 99. Then we'll interpret our results. Historical simulation is a non-parametric model that is based on belief that history will always repeat itself, makes use of sorted return in order of worst to best. The steps involved include collection of data, computation of asset returns, sorting of returns in order of worst to best, calculation of mean of asset returns, calculation of standard deviation of asset returns, an estimate of historical VR for each of 90, 95, and 99 confidence level, and finally with data interpretation. Monte Carlo simulation is a parametric method that takes iteration of large number of data sample to obtain a value at risk measure, a stable value at risk measure. The steps involved include calculation of mean of asset return, calculation of standard deviation of asset return. We generate distribution for 1000 trials random values, which we use to run our Monte Carlo simulation for different market conditions. For each of these trials, we simulated returns through relationship in step 2, and we plotted histogram of our simulated returns. Then finally estimate our simulated VR. Our portfolio construction involve combining of all the 12 assets to obtain an optimum weight through efficient frontier techniques. As can be seen, the emerging market bonds, pan-European aggregates, and pounds, they have the highest weight. But of course, if we add up all the 12 asset class, we will arrive at 100. Estimated shortfall. For comparative analysis of estimated VR, we further measure estimated shortfall, which is a sub-additive properties, and of course it accounts for losses that is beyond VR. We assume a day holding period and computed CVR at 99% for both normal and student T distributions. Results and analysis. Our VAR computation for variance covariance showed that crude oil first contract has the highest value, while the bonds, especially pan-European aggregates and the US, has the lowest VAR value. For our historical simulation VAR computation, the same thing, crude oil showed higher value compared to others, while bonds recorded lower VAR. For our Monte Carlo simulations, it also go in the same pattern with VAR, bond also coming last. We also plotted histogram of, for instance, Japanese yen, which shows that the returns are distributed between -2 and 2. The same goes for US corporate yield. Its returns are distributed between -0.75 and 1. The graph of our asset portfolio efficient frontier show volatility between 0 to 25,000 and Sharpe ratio, while our return is computed on the other axis. It is based on this that we're able to compute our optimum weights. The result of our portfolio analysis, most early when we invested 1 million at 99% confidence level, shows that the VAR of portfolio holding is 8,022.5, while the aggregate VAR for the 12 assets is -17,658.24. COM first commodity contract has the highest VAR. At 95%, our portfolio holding had -5,613.45, while the combined asset has VAR of -12,426.43. For 90% confidence level, our portfolio holding has -4,329.19, while combined assets has -9,637.38. It is noteworthy to say that CON maintained the highest in terms of VAR. We then do comparative analysis of our results of normal VAR with expected shortfall, which is also called CVAR. Example of our asset computation is FOREX Japanese yen. It has a mean of 0.0007, sample standard deviation of 0.00597. We assume 1 day holding period of 90% confidence level. Our NVAR is 1.38. Our NCVAR is 1.58. Our student TVAR is 1.57. Our student TCVAR CVAR is 2.7. As you can see, TCVR has a higher value. We also computed similar thing for stocks using Euro stock index. The sample mean is 0.0020. Sample standard deviation is 0.01293. Same condition, same assumption. Our normal VR is 2.99. Normal CVR is 3.43. Student TVR is 3.37. Student TCVR is 8.28%. We did for commodity. Corn, first contract. It has a sample mean of 0.00019. Standard deviation of 0.01766. Normal VR is 4.09. Normal TVCR is 4.69. Student TVR is 4.66. Student TCVR is 8.18. For bond, we display pan-European aggregates computation. Sample mean is 0.0018. Sample standard deviation is 0.0021. Normal VR is 0.47%. Normal TCVR is 0.54. Student TVR is minus 0.02. Student TCVR is 2.81. The summary of our analysis, of our comparative analysis, shows that the crude oil first contract maintains the highest in terms of normal VAR, normal CVR, and student TVR, while the Nigerian stocks has the highest in terms of student TCVAR. Our stress test, our stress VR that was computed also show a similar trend in terms of performance, of crude oil first contracts, which was also observed in previous computations. Our key findings: crude oil first contract has the largest VR covariance at 90 and 95 and 99 confidence level. The US corporate yield had the least at 90 confidence level, with pan-European aggregates recording the least VR at 95 and 99 respectively. In terms of historical simulation VR, crude oil shows similar value as observed for variance covariance VR, with US corporate yield and pan-European aggregate recording the least. However, the historical simulation VR is higher when compared with variance covariance VR. Crude oil first contract follow similar pattern even with when we make use of Monte Carlo simulation VR, and pan-European aggregate came last. It could be observed that the expected shortfall and stress VR have larger than value than normal VR. Estimate increases even as confidence level increases or as probabilities decreases. From hypothetical 1 million portfolio investment, the VR of portfolio holding is lesser than sum of 12 assets combined, which explains the impact of diversification of risk. First contract has the highest VR, while Japanese has the lowest VR at 99% 95% and 90% confidence level. Crude oil first contract showed the highest VR for 1 day, normal VR, 1 day, CVR, and 1 day student TVR at 99% confidence level, while Nigerian stock has the highest 1 day student T CVR at 99% confidence level. Both normal and student T VR are higher in value when compared with normal student T VR. Straight VR is also higher in value than VR at 99% confidence level. Limitations of value at risk. The value at risk can be misleading as it gives us sense of security, does not measure worst case scenario. Value at risk gets difficult to calculate with larger portfolios. It is not additive. More reason why we have to calculate expected value shortfall and straight VR. The resulting VR is also only as good as the inputs as well as the assumption that is applied. Different VR leads to different results. Conclusion: despite the limitation mentioned above, VR is widely used by industry, regulator. Expected shortfall and stress VR have larger value than normal VR, an indication that both techniques quantify fat tail risk and account for loss beyond VR. Asset allocation remains the best strategy of risk management as well from our asset portfolio. VR is very useful to measure risk, but it is insufficient in itself. From our findings, the techniques could be used alongside with other methodologies that are expected short form to have an holistic view of risk. Though we have carried out this research based on historical data, we believe further work can be done through backtesting of techniques on real-life data. Thank you.